Live from Hong Kong, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. President Trump revs up the trade war with a 25% tariff on all cars imported into the U.S. The move comes ahead of its broader push with reciprocal levies next week. Trump offers China a carrot, saying he would consider lowering duties in return for Beijing's support for the sale of TikTok's U.S. operations. As worries swirl around the U.S. economy, investors are betting that good times are only beginning for emerging markets. The EM equities gauge set for its best first quarter since 2019. And to map all the risks and opportunities around tariffs, Macquarie Capital's head of Asian autos, James Hong, will be joining us, along with AXA Investment Manager CIO for Asia ex-Japan, Ecaterina, Bigos.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%.
Well, shares of Asian automakers are slumping as President Trump shifts the trade war to a higher gear. Transport reporter Danny Lee joins us for more. We didn't really see this coming, Danny.
Yeah, and now what we are getting is a 25% tariff on global automakers effectively trying to sell into the US, and very few global automakers are going to be spared from this, frankly. And
not even the US automakers,
no,
right?
Not at all. And you see the kind of numbers we're looking at, and I think the one at the top is that you have Volkswagen, who sells into the US. 80% of their sales are going to be impacted. And some of the numbers we are looking at, Hyundai and Kia, they could face up to $7 billion more US dollars annually in extra tariffs. And even for like the likes of GM, with about 46% of their sales impacted. So there's a lot of exposure out there, and no one is spared, except for like the Chinese automakers who don't sell into the US.
That's right. And the thing is, some are estimating that perhaps you can add about $10,000 more to the price of cars.
The question is, who pays for these tariffs? Is this going to be higher sticker prices on cars? Is this just going to be absorbed by automakers? But this will really crimp into profitability, and the likes of Goldman Sachs saying a Nissan could face a 56% fall in operating profit, regardless of which way this goes. So, and for someone like Nissan, who is vulnerable, and given the likes of the Japanese have been lobbying for exemptions, and Trump is pushing back, saying we're not going to be putting on exemptions here. This is a big blow for the automakers at large.
And Danny, hang tight. We have breaking news right here. We have China saying that it wants to pause new deals with Li Ka-shing's family. Of course, that's on the back of what happened earlier, on the back of Li selling that 2 Panama ports to a global consortium. There's pressure on Li and his family, of course. Trump hailing that sale as China reclaiming, as U.S., in fact, reclaiming the canal from Chinese influence. China, of course, now looking for loopholes, potential for national security, as well as antitrust violations. Again, China is said to be pausing new deals with Li Ka-shing and his family and seeking the cooperation of state-owned enterprises. Danny, just to continue with our conversation, I mean, where do we go from here?
Well, we are going to expect more tariffs coming in the next week or so. And on April 2nd, this so-called Liberation Day that Trump has been building up towards. So
reciprocal tariffs.
Reciprocal tariffs. And so this specific industry set of tariffs could raise $100 billion US dollars, the Trump administration expects. So we could expect a lot more down the line. And, you know, the auto industry at large and governments, particularly those with the big auto majors, had been looking to see what they could do to mitigate the impact of tariffs. But at this point, Trump is not pushing back and pushing further ahead with things to try and boost the US auto industry, but at the same time at the expense of potentially some of Detroit's own big names.
The question really is whether these tariffs will be permanent. I mean, we talk about how it is a negotiation tool for Trump, whether it will stick, whether he's open to further negotiations.
Well, it seems the message is that this looks like this will kind of be a permanent thing, or at least for at least the time the Trump administration remains in office at the very least. You never know what's going to happen down the line. But at the same time, the fact that Trump doesn't appear to be backing down too much. We have seen him waver on some of the earlier policies, but for something like this, and depending on how much the big three in Detroit raise further concerns about what this could mean for jobs or investment perhaps, but even then we have seen some of the foreign automakers like Hyundai and Kia commit $20 billion into the US already in the last couple of days to try and get ahead of these tariffs, but they still feel very vulnerable at this stage.
Sure, implications on growth, implications on inflation, a lot to think about. Transport reporter Denny Lee, thank you so much for that. Now, investors are also assessing the broader impact of auto tariffs on Asia's economies and markets. Avril Hong is here with a closer look. Avril, you got to imagine whatever is left of that risk appetite is now gone.
It's gone, but it's also interesting how the money seems to be flowing into Chinese markets, right? So we're seeing that outperformance. And I think our M-Life strategist, Mark Cranfield, put it best. Confusion breeds contempt. So why wait for clarity on the tariff front, right? Your money finds a home in markets where the narratives are a bit clearer. That outperformance, as I say, on the Hang Seng, but Japan, South Korea benchmarks looking vulnerable amid the selling in auto stocks given the tariffs. We heard from the likes of Prime Minister Ishiba suggesting that they're not ruling out countermeasures, maybe kicking things up a notch when it comes to the tariff war. And while these tariffs might apply across the board to all countries, so Japan maybe maintains some of its relative competitiveness in that sense, keep in mind that when it comes to its exports to the US, about a third of it still is made up of autos and auto-related products. Now, there are also countercurrents today to keep in mind. In the Asian session, we saw that selling in the likes of NVIDIA, AI infrastructure, related stocks in the US amid reporting that China's new energy rules for advanced chips could hit some of these, NVIDIA sales. So we're seeing the chip makers in the region and chip-related stocks, the drags, including on the likes of the TAIEX. Now flip the board, because all this is really frustrating for the bulls in the region. If you take a look at the region's benchmark, it's been struggling to breach some of these 190 levels convincingly. And we've also been seeing it not far from its 50-day moving average, so suggesting that there is room to fall. And if you flip the board again, just to put things into further perspective for you, when you take a look at how there's been a rotation away from U.S. tech stocks into Chinese tech stocks, keep in mind as well that this week on the Hang Seng Tech, we almost approach correction. And I think it would be helpful even for these Chinese tech names to get some clarity on the tariff front and maybe also show how AI can enhance their profitability, Has.
Understandably, it is hard to be a bull in such an environment such as these. Avril Hong, thank you so much for that. Now let's discuss the tariff threat and market implications with Ecaterina Bigos, CIO for Asia ex-Japan Core Investments at AXA Investment Managers. Also with us, James Hong, Head of Asian Autos at Macquarie Capital. James, let's start with you. What are you making of these 25 tariffs for autos? Does that seem like it's going to be a massive headwind for the sector?
Yes. When you look at the global automaker in Asia, such as like Toyota or Hyundai, Kia, or Honda, they make near 40% of profit in the U.S. today, given that obviously U.S. is where they don't face competition from Chinese. And also their hybrid powertrain and hybrid vehicles are very popular, which actually led to a 20-something% margin for some of the automakers like Toyota or Kia. So clearly the U.S. is a market where they can give up, and thus the 25% tariff can be a big blow to these companies once being implemented. But if you think about from the U.S. consumers' point of view perspective, obviously they are probably the one who suffer the most from these import tariffs, as 40% or 50% of vehicles today are being imported from outside the U.S. And even if you include some of the vehicles from imported from Canada and Mexico under the current trade agreement called USMCA, and the White House also mentioned that there will be another tariff against these products as well. So effectively, it will hurt 75-something% vehicles that are sold in the U.S., which will probably be a big blow to the consumers.
So it's going to be more expensive to sell and buy cars in the U.S. Square this for us, because President Trump talked about making $100 billion in new revenue out of that.
Yeah, I mean, this is going to be paid by consumers. I mean, given the difficulty some of the automakers already have. If you look at historically, Nissan and Stellantis, or these conventional automakers, always been prioritizing their market share or their volume. But we're clearly living in a different environment where all these companies are forcing to invest into autonomous vehicle and robotics. And obviously, all the companies are become much more focusing on the profitability. So we don't expect the automaker just to chase the volume. I'm sure there will be some middle point where they do pass on to the consumers and part suppliers, but at the same time, they try to mitigate all the cost impact. So again, to us, the way we see this is that the consumers are basically being the biggest loser as a result of this 25% tariff.
Ecaterina, the consumer is the biggest loser. It is inflationary.
It is inflationary, but I think we need to be a bit more sanguine looking at the implications of
tariffs. Is that even possible to be sanguine?
Well,
right
we
now?
have to be, because it's a lot of uncertainty, it's a lot to unpeel, and I think ultimately we need to look. We don't know yet the implications, because obviously when we impose tariffs, currency has an element of it. Again, the weakening of a currency from the country that's exposed to those tariffs can absorb some of that shock. The supply chain can absorb some of that shock. And then obviously we have, and we've seen that Trump has announced that they'll potentially put some relief on consumers, i.e. if they take a loan, that interest will be subject to potentially some tax relief. So I think there will be a balanced way in which consumers probably will absorb. Certainly, the prices will likely to increase. They'll be inflationary, but in the magnitude of it, again, we need to see how that gets panned out and manifested. Yeah.
You can imagine it's a headache for central banks like the Fed.
It is a heading, absolutely is a heading. And I think what the challenge for Fed is, and we saw it during the meeting, is that they have to stay on pause to see additional data to make the next decision. The next decision is not on the data. They don't know what the implication, precisely as I said. As much as we can sit here and calibrate and put forecasts in place, we don't know how all of these tariffs and uncertainty will manifest into the inflation. The view is that it will be inflationary, but how it's going to manifest, when it's going to manifest, and the magnitude of it, that will lead to the reaction of the Fed. The more important part, and I think where the challenge for the Fed will become more complex, is if the inflation rises but the growth subsides. And I think the sooner the administration gives clarity around this tariffs, puts a framework in place that it's credible and companies can follow, that allows the companies to move on and say, okay, this is the reality, this is the framework, let's continue to work with this framework that will be for the sustainable period of time, that can allow for future investment and, again, future earnings growth that can allow for the growth to continue. The biggest challenge for the Fed will be if the inflation gets disanchored and we have a growth that is getting impacted.
But isn't it a higher risk now that growth will subside as it stands, even without the reciprocal tariffs? That was already a downgrade in terms of U.S. growth for 2025.
There has been a downgrade, but we shouldn't forget that coming into 2025, the expectations were just too bullish. Everybody was looking at the new administration with the positive lens of the potential pro-growth measures, with potential deregulation. And we've said in our outlook that the timing on when the Trump will impose the tariffs will make a difference. And it's fair to say that tariffs have come first because, again, it's where the administration or the president has the most leeway to implement it. And for him to offer the administration to pass on additional tax cuts, they need to prove that they have additional revenue sources. And again, there's very little time they have to implement all of this because, again, we have the midterms and there needs to be an effective execution or fast execution of what they want to achieve. And ultimately, some of the growth has been revised, but we have to understand that U.S. has a significant growth momentum that was already in place. That's going to continue. Some revisions have been done, but we also have to look at what's happening as a consequence of these tariffs. All of the partners are aiming to subside some of those tariffs through additional investments. And we've had already significant investment for private side in the U.S., again, in tech. We had, obviously, the CHIP Act, which has injected already, and the IRA, the Inflation Reduction Act, which has already implemented through investment in the economy. And then we obviously have, going forward, and we see already some of the trading partners that are injecting additional investments to counteract some of these tariffs. tariffs. So the investment has been redirected to U.S. And we shouldn't forget, despite of all this noise, we have to understand that U.S. economy still has that resilience, that and momentum that is likely to sustain. Again, a bigger shock could put that downward pressure on it. Yeah.
James, we know that for countries impacted by the 25 auto tariffs, they're not going to be sitting on their hands. Canada said it will respond. We have Japan saying that it is considering what is the right response. How do you see this playing out? What will this look like, I don't know, 2-3 years down the road?
Well, I mean, if you look at how the trade work between the Korea and Japan with the U.S., Korea and Japan basically export too much to the U.S., while we are basically importing too less from there. So I guess the response from the Korean government and Japanese government can be quite limited. At the same time, as Japan mentioned, they're looking for the right way to work with the U.S. Like, I think the Hyundai's announcement a couple of days ago and the PM Ishiba's meeting with the Trump actually shows that the textbook tactic or trade tactic of these Korea and Japan companies, right? I mean, if you look at what Ishiba mentioned to the U.S. and Trump administration, he basically talked about, one is that Japan is a good ally, good friends of U.S. in the longer term, and they're actually investing a lot into the AI infrastructure and everything. And two, he talked about Toyota and Hino is already building capacity, local factories in the U.S. And three, he actually mentioned about buying more U.S. LNG, which obviously is one of the key agenda of the Trump. So I guess this is basically how the Korea and Japan will deal with the tariff issue. I mean, auto industry and auto export to the U.S. is so very too big just for these companies to give up. And there's not much of leverage that Korea and Japan has against the U.S. when it comes to like retaliation, right? Because if you look at Korean market or Japan market, less than 1% is actually the U.S.-made vehicles. I mean, most of the vehicles, because the Korea already had free trade agreement of most of their partners, 0% tariff on all the U.S. and European products. A lot of European premium brand export directly, while there's not much going from U.S. to Korea. It's the same for Japan. I mean, Japan basically has no tariff for the U.S. export, while the U.S. currently has 2.5% tariff against the Japanese export. So I don't think there is not much thing that the Korean and Japan government can do, especially related to this segment. I mean, the only way they can do is actually finding a peaceful way or come up with some of the solution or some of the suggestion to the Trump so that basically can exempt the taxes. That basically is what
James?
I think Hyundai did. Yeah.
I'm curious to see how Tesla will be impacted. Will it gain or will it be in significant pain?
I guess it depends on how these countries, let's say Europeans, respond to this tariff measure. If there is some sort of like anti-U.S. sentiment build up, I'm sure they won't be not immune to that. So the sales-wise, as seen in the last couple of months, sales will be negatively affected. Although at the same time, the sales weakness of Tesla was due to the model refresh of the Model Y, which is the most important model and largest volume model they have. I guess when it comes to U.S. alone, I mean, as most of the production is actually done in the U.S., I mean, they're actually okay. The impact to the Tesla operations mostly should be decided by the anti-U.S. or the consumer sentiment outside the U.S., especially European market.
Ecaterina, where do you hide? Where do you put your money? How do you make sure that your capital is safe?
Well, I mean, it's been an interesting evolution of markets, certainly, but there are places to hide. And I think there's been quite a few developments that has led to some unintended consequences in investment. And tariffs has been one of them. The decoupling or geopolitical decoupling has been a second one, which has led to Eurozone reaction, particularly Germany, to finally amend its debt brake. And I think those has led to markets perform in a different way than we envisaged at the beginning of the year. Certainly, we've looked at at being a lot more diversified, a lot more looking at what are the implications from those developments that allows to harness the alpha. And there are alpha opportunities. And if you look at the market behavior at the moment, yes, there's been a re-rating, but it's not been uniform. So we've seen a significant re-rating in tech, again, volatility, but also mainly downward re-rating, but it's been driven by DeepSeek as well. So tech innovation has led to re-rating in tech. It's not been necessarily the tariffs. Again, companies that are deemed to benefit from tariffs in the US, like a smaller cap companies, have done fairly well, because if this tariff program is executed in a right way, you could extrapolate and say some of that manufacture will come back home and the home-focused companies will benefit from it. So it hasn't been an even correction. And then we look at Europe, certainly the shift in that fiscal, the ability for Europe to grow from here, that fiscal injection from Germany has completely shifted the narrative and certainly the appetite for Europe. And lastly, with China as well. Again, China still has structural and macro problems, but that tech development that we've seen is certainly decoupling it from that underperformance. But it's not uniform. So again, we need to look at what are the values and what drives the market. And I think there's still that alpha there.
You talk about how it's not uniform. Can we talk about maybe emerging markets in general having their time in the sun or not?
Emerging market potentially could, and I think that when you look at emerging markets, it's a question of valuation, so valuations are still attractive. Then the other element of it, and we call it the second layer of ramifications from all of these tariffs, what are the potential consequences of tensions between, let's say, Eurozone and US, tensions between China and US? Will there be more cooperation between emerging markets and China and Eurozone? And what are the potential beneficiaries of that spillover, right? And I think that's where, again, we don't know how this is going to manifest, but if you had to extrapolate, I think EM has a scope to take a little bit bigger share in kind of the layout of supply chains and manufacturing in the future.
Ecaterina and James, thank you so much for your time today. James Hong of Macquarie Capital, Ecaterina Bigos of EXA Investment Managers is sticking around now. We want to take you to Boao, where Chinese Vice Premier Ding Xuexiang is making his speech at that forum in Hainan. Let's take a listen.
I'd be interested in where China's economy is heading and look to China to provide more certainty to the global economy. Let me use this opportunity to make 3 observations. First, the Chinese economy is growing steadily with a stronger outlook. Despite a surge of difficulties and challenges last year, our economy grew at a rate of 5%. China ranks among the world's fastest growing major economies and accounts for about 30% of global growth. In January and February this year, our economy got off to a steady start. The key indicators of industry, consumption, and investment all grew faster than 2024, continuing the upward momentum shown in the fourth quarter last year. The growth target for this year is set at around 5%. This is based on rigorous projections and methodical planning, underpinned by China's growth potential and favorable conditions, and supported by robust policy measures. We will enforce more proactive and effective macro policies, stimulate domestic demand across the board, actively stabilize foreign trade and investment, double down on the healthy development of the property sector and the stock market, effectively prevent and diffuse risks in key areas, and do our best to fulfill this year's goals and tasks for economic and social development. China is confident of realizing these goals and will further contribute to development in Asia and the world. Second, the Chinese economy is remaking itself with a growing capacity to drive growth through innovation. China's firm commitment to an innovation-driven development strategy has led to a notable boost in our innovation capacity and a successful transition from old to new growth drivers. This has not only helped us tide over economic difficulties, but also lifted our medium to long-term growth prospects and potential. You may have seen Chinese tech companies unveil their latest humanoid robots and large AI models, boosting momentum in their own sector and confidence in the market. They are success stories achieved through a persistent effort to develop a new driver of growth in the Chinese economy. We will move faster toward greater self-reliance and strength in sophisticated science and technology, facilitate the integrated development of technological and industrial innovation, and foster and expand emerging and future industries, even as we transform and upgrade the traditional industries. Today, the pursuit of high-quality development has become a nationwide consensus, and the drive to develop new quality productive forces and spur innovation has become a widespread trend. In my view, apart from new energy vehicles registering rapid development, other sectors such as AI, biomanufacturing, quantum technology, and low-altitude economy will also thrive across China. There are not only opportunities for China, but also opportunities for Asia and the world. Third, China is deepening reform and opening up across the board to deliver a more pro-business environment. The third plenary session of the 28th CPC Central Committee laid out a master plan for further deepening reform comprehensively to advance Chinese modernization. We will accelerate the implementation of landmark reform measures, better leverage the leading role of economic structural reform, and refine institutions and mechanisms to better support high-quality development. The private sector is a dynamic force in advancing Chinese modernization. Its rapid growth in recent years testifies to the strong dynamism of the Chinese economy. At a recent meeting on developing the private sector, President Xi Jinping made important remarks that resonated strongly with the audience and beyond. The process of enacting a private economy.
Welcome back to Insight. Bloomberg has been told that China has instructed state-owned firms to hold off on any new collaboration with businesses linked to Li Ka-shing and his family. This comes after the Hong Kong billionaire urged Beijing with his plan to sell 2 Panama ports to a global consortium. Bloomberg's China correspondent Min Lo is with us in the studio. Li and Siki Hutch under a lot of pressure from a very unhappy China.
Yes, and this latest development is quite interesting because we understand that the directive came last week before the China Development Forum, and actually Li Ka-shing's second son was invited to attend that forum, which analysts took as a sign that the company is still not in this unredeemable blacklist yet. But we know that Beijing has been scrutinizing that deal, not just to sell those 2 Panama ports, but almost their entire fleet of about 43 ports in 23 countries, except the ones in China, to BlackRock Group for $19 billion. And Beijing has expressed its displeasure. It's investigating that for any potential violation of antitrust regulations or national security concerns. And now, I guess this is Beijing's way of exerting pressure on the company, because it's not clear what sort of leverage the government has on the company, given that this deal takes place outside of mainland China and Hong Kong. The company derives about 12% of their revenue from China, but still they have quite significant dealings there. They have an insurance arm that is looking to expand in China. That could be at stake. They also have a property arm that has about 1/5 of their long-term rental investment in China as well, by land area. So pretty, there's some big stakes involved, even though the family has over the years really divested a lot of their operations from mainland China because of these geopolitical risks.
And all against the backdrop of US-China friction, right? I mean, China now renewing. Some hope perhaps that, those levies could be, eased in a way, but it has a lot to do with TikTok. Let's take a listen.
I'm worried about our country more than anything else with respect to TikTok. And China is going to have to play a role in that, possibly, in the form of an approval, maybe. And I think they'll do that. Maybe I'll give them a little reduction in tariffs or something to get it done.
So, is it realistic to think that China could get an exemption? Everybody's been trying to get that exemption and no one's been spared.
Yeah, well, we have to wait to see what Trump does next week, but he's saying that he's willing to sacrifice those tariffs in exchange for Beijing's support to sell TikTok. And remember, the deadline for divesting is April 5th, after he managed to get that 90-day delay. So he said he's confident of getting some form of outline for this deal by next week with China, but he said if not, he's also confident that he will be able to get another delay as well. So question is, will China be willing to sell TikTok, because they have listed the algorithm of TikTok under an export control list. So selling TikTok without that algorithm could run the risk of not fulfilling the terms of that divestiture. So Trump has said he has spoken to about 4 bidders. He didn't name names, but we know from previous reports that there had been some groups of investors, including one led by Frank McCourt, a billionaire, another one involving Mr. Beast, who is a famous YouTuber. Also, Oracle could be also throwing his hat in the ring. So we'll see. We have Steve Daines in Beijing this week saying that no tariff talk could happen without Beijing agreeing to stop the flow of fentanyl. So we'll see how the negotiations go next week.
Once again, and we keep hearing this, it's wait and see.
Yeah.
China correspondent Min Lo, thank you so much for that. Now, an advisor to the Chinese Central Bank says the economy has gotten off to a good start this year, but authorities are prepared to deploy more stimulus if growth loses momentum. Huang Yiping spoke exclusively with our Chief North Asia correspondent Stephen Angle at the Boao Forum.
The government has made it very clear that if there is a need, both the fiscal policy and the monetary policy can step up. That, I think, is very clear. So basically, it will be data-driven. If the economy is strong, then perhaps we can just go with it. But if the economy shows signs of softness, then both the fiscal and the monetary policy still have enough scope for further expansion.
How would you assess it right now, coming out of the National People's Congress? There seemed to be a lot of talking about green shoots of confidence, but the property market in the first couple of months was still quite weak. Consumer demand still quite weak. And they didn't necessarily announce specifics on easing or further large fiscal outlays other than long-term bonds and the like.
Yeah.
Do you see right now the need for further easing?
Well, I think that we need policies to be ready if we need. As I said, it's a data-driven decision. But what we saw was after the end of September last year, the policies turned around and the numbers picked up. So the fourth quarter was much better than the third quarter. If you look at the high-frequency data for the first couple of months, I think we actually had a reasonably good start. Obviously, we needed to prevent replay of what happened before, that is the second quarter and the third quarter weaken again. And on that, I think the readiness of the fiscal and the monetary policy to support the economy would be very useful.
In the first Trump trade war, we saw, I don't want to use the term weaponization of the yuan, but we did see the weakening of the yuan, some 11% over 2 years. This time, the PBOC has kept it very steady and stable. Is that sort of weakening the overall easing buffet that is at their stable? Should they weaken it further?
Well, there are many different arguments. If you weaken the currency, that might be useful in the short term for exports. But at the same time, as you know, exchange rate also has a big impact on the capital flows. It has an impact on trade flows, but also on capital flows. I think for the policymakers, you have to balance, trying to weigh which is more important. If the currency is weaker, and hopefully if it gets lots of exports, then it's good. But it's possible that you might not get a lot of exports while you weaken the confidence on investors. So I think, in my view, is that, our exchange rate is still managed afloat. So management is still part of it. At the end of the day, you need to balance the likely impact on different parts of the economy.
What do you think the policy response so far to the external shocks? Has it been successful enough? We don't know what's coming on April 2nd. There could be further tariffs. Is China going to be able to weather this external shock?
Well, China will be able to weather the external shock. The question is how big will be the shock. But that's also in line with the policy direction going forward. Exports will be important, continuously to be important. The question is, can China continuously rely on exports to drive Chinese growth? That's why the priority actually now is more on expanding domestic demand, particularly domestic consumption.
And that was PBOC advisor Huang Yiping speaking exclusively with our Chief North Asia correspondent Stephen Angle. And economist Stephen Roach says he's skeptical about China's plan to boost the economy through consumer spending. He told us that's down to public worries about the social safety net and the preference to save rather than spend in a time of uncertainty.
What I'm worried about, Steve, is that their program is more slogans than substantive actions that really give me confidence that the consumer revival is at hand.
Ecaterina Bigos from AXA Investment Managers is still with us. She thinks redirecting the Chinese economy towards consumption will take time, prolonging its reliance on trade-led growth. Ecaterina, under such a circumstance, with tariffs everywhere, it is going to be really difficult for China.
It is difficult, and we don't have, obviously, they put a target of 5% for this year. We do think it's an ambition. Our view is more like around 4.6. If you look at the 4 pillars that China relies on, obviously you have investment, which is investment in infrastructure. We do think the investment will continue, but it's going to shift away from the roads and bridges into more data centers, so more private potential investment and supporting that growth for investment. So investment will be present. Then you have manufacturing, which, as we've heard, China is going to continue to lean into manufacturing because it's a big source of that GDP contribution. But it's going to be more challenging. Again, we'll know on 2nd of April how challenging that's going to be. So redirection of some of that trading potentially to the global south could be a possibility, but it's going to be more challenging for manufacturing to succeed, considering that they went up in value chains of manufacturing, which is posing concerns of social security concerns for a lot of the West, but the market share concerns as well. And then you have consumption, which is subdued, and it's been, I think, it's a China story. The population has a propensity to save. It's never been a big consumption economy, and shifting that narrative, as I said, it's going to take some time. The policymakers need to do more than just what they've done with regards to some incentive of trade-in programs and so on and so forth. So it needs to be a lot more around safety net. Labor market needs to improve, income generation needs to improve, and the wealth creation needs to improve, which is very tied to the property market. Again, this is the 4th pillar of that contribution to growth, and property market is still very much subdued. We've seen some signs of recovery, Tier 1, Tier 2 cities, but the lower tier cities are very much in that excess inventory that needs to be absorbed.
So there is a huge question mark still. Yet when we heard from Vice Premier Ding earlier on, he talked about how growth has been steady, and he's looking for stronger growth from here. How is that possible?
Well, I think the big reliance at the moment is that the policymakers will do more. The reason that, and we've heard it, they haven't acted as much, partly because, again, the concern of misallocation of resources, which has happened in the past. When they came with a lot of fiscal stimulus, it get misallocated, and we've had this property crisis and a leverage in the local governments, which we're faced with. Again, preempting certain economical weakness with measures that are potentially excessive and not directed at the right places is a concern. And ultimately, I think they keep the dry powder to see what's going to happen on 2nd of April. Where do we need to lean on? How do we need to respond to that?
So what does it all mean for the rally we've seen in Chinese stocks, driven particularly by the tech stocks, the AI-related stocks? Can that be sustainable if fundamentals are still not quite intact?
I think for tech, there is a story that's emerging, and I think what DeepSeek has done is brought into focus the fact that LLMs or the AI models will come from a broader set of players, and I think that's China easily. And the fact that it's open source just lets a lot of companies to tap into and potentially test how that can improve productivity, maybe potentially improve earnings, but it's a longer-term journey. The immediate beneficiaries, of course, are the tech, because they can implement quicker, and it's e-commerce, it's going to implement it, which can increase the sales and the broader productivity for those companies. I think the broader ramification of AI, it's a longer-term story and potentially can impact earnings. But if you look at this year, we've had revisions in the tech space, consumer discretion, but the broader sectors, other sectors, are pretty much earnings expectations are subdued, and unless we have a recovery and China getting out of this deflationary pressures that we're seeing at the moment, consumption coming back a lot more swiftly, it's going to stay subdued. Earnings are challenged for recovery at the moment.
Of course, we've seen a rotation, and that's driving the rally. The question is, where does it go from here? I mean, how much support from foreign investors, foreign funds, do you see them coming back?
Well, they're coming selectively, and I think as much as we've seen a rally, a lot of it is still local participants. We've seen some allocations from foreign, but real monies have not jumped yet. And then also we need to look at the ramification of geopolitics. Will certain investors be allowed to invest in China? Some of those companies are potentially subject to security ramifications that U.S. might put in place. So I think it is premature to say that foreign investors have chased the rally. I think on the periphery, yes, but I think the real money has not chased the rally yet.
When you take a look at flows in the market, what is it telling you? I mean, how much has the market priced in all the uncertainties, the tariffs, you know, the slowdown in growth that is expected for the year?
I think market is trying to find direction, and as I said earlier, there are three pillars that have given the market a little bit of a direction. It's been obviously the U.S. tariffs and decoupling a little bit and understanding what the ramification could have on the U.S., and we've seen a rating on the U.S. market. We've seen the fiscal shift in Eurozone that gave a direction for the market, and I think the Eurozone has a stronger story longer term. And the third is this tech evolution. As much as just DeepSeek is present in China, it just gives, again, a sense that this will be a story that will persist, and investors should stay invested in tech, and they need to understand how that will manifest, who are the beneficiaries of it. And at the moment, it still stays in training those models. So still data centers are potentially going to be present. We've seen a re-rating in that. But going forward, we'll still need data to train those models, and that is going to sustain the supply chains. That's going to be beneficiaries not to companies just present in the U.S., but also in Asia, which are part of that supply chain for tech. Yeah.
Realistically, what kind of returns do you think you can get from the equities markets this year?
Again, selectively, there is scope to have positive returns, but again, we need to be selective.
Double digits?
You could have double digits again, but it's already been double digits if investors stayed in the right place in the market. It's hard to gauge it at the beginning where you should be, but once we have clarity around these tariff implications, investors will be able to gauge that sense. But we've seen already a double-digit rally. We've seen it in Eurozone and certain sector. Banks are doing phenomenally well because they're beneficiaries of some of the immigration that we've seen in the periphery, i.e. in Spain. They're beneficiaries of that fiscal support, which a lot of lending will come probably from the banks. So it's already double digits. And within tech in China, and of course we'll see US potentially navigating to a better returns in a second part if we get clarity around tariffs.
Ecaterina, thank you so much for your time today. Ecaterina Bigos of AXA Investment Managers. Of course, we've been front and center on that story about the 25% tariffs on automakers. Let's do a check on how Japanese car makers are doing on the back of that. Japan, among the markets set to be impacted in a huge way by that 25% tariffs, along with South Korea. Toyota, Honda, Nissan, Subaru, all in negative territory. We have Subaru Corp currently down by more than 5% and about 2.5% losses for the likes of Toyota, Honda, as well as Nissan. Of course, we had the Japanese economy minister, Yoshimoto, speaking in Tokyo, saying that Japan will do its best to analyze the impact on the companies. Of course, Japanese economy minister Yoshimoto speaking in Tokyo, saying it will try to analyze the impact on the companies. Taking a look where we are in terms of those Indian car makers, this is how it's looking as we count down, or in the first few minutes of trade in India, currently also in negative territory. Tata Motors down by more than 5%. Mahindra, not spared, currently down by 0.8%. Of course, Tata Motors, the parent company for Jaguar Land Rovers. And speaking of Jaguar, let's turn to the UK. It is expected to be impacted as well. Cars, by the way, the biggest exports to the U.S. for the company. We're also keeping an eye on Tesla. Remember, the question is whether Tesla will gain or not from those 25% tariffs. We heard from Elon Musk himself. He said, to be clear, this will affect the price of parts in Tesla cars that come from other countries. The cost impact is not trivial. So it does seem like everybody's on the edge. Everybody's expecting some implications. Still to come, Democratic Senator Elizabeth Warren speaks exclusively to Bloomberg, calling for U.S. Defense Secretary Pete Hegseth to quit or be fired over the Signal texting leak. That interview just ahead. Keep it here with us. This is Bloomberg. President Trump says no harm was done after a journalist was accidentally added to a high-level Signal chat discussing military attacks in Yemen. Newly disclosed texts show Defense Secretary Pete Hegseth revealing specific operational details. Trump and his team say the information was not classified, but lawmakers, including some Republicans, are calling for an investigation.
I noticed this morning out came something that doesn't look like war plans. And as a matter of fact, they even changed the title to attack plans because they know it's not war plans. There's no units, no locations, no routes, no flight paths, no sources, no methods, no classified information.
National Security Advisor stated no classified information was shared. There were no sources, methods, locations, or war plans that were shared. This was a standard update to the National Security Cabinet that was provided alongside updates that were given to foreign partners in the region.
Democratic Senator Elizabeth Warren is among lawmakers calling for a congressional hearing on the Signal text incident. She told us exclusively that Defense Secretary Pete Hegseth should be fired if he refuses to step down.
If Pete Hegseth had a shred of self-respect and decency, he would resign. That's what leadership is about. And instead, Pete Hegseth thinks it's all about point at somebody else and minimize the problem and sweep it under the rug and deflect. You know, you want to be a leader of the finest armed forces in the world, then step up and take some responsibility.
Should he be fired? You talk about him resigning.
If he won't quit, then he should be fired. Because he has put our national security at risk. That's part one. Part two is you realize a bunch of this is potentially, certainly, breaking the law. So, for example, because of the Freedom of Information Act, there are laws that require that people in the administration, all of them, have to preserve the records of their texting back and forth. I know this from the days when I served in the administration, and we were carefully cautioned about the importance of preserving records. Signal, as you know, disappears those records. And I will say on this, when I read how casually they just formed this chat, notice that's how you refer to it, right, to discuss the national security issues and the bombing of another country. How many other times are they using Signal, and what are they using it for? So this is a moment, we need some of those congressional investigations. We need a hearing in the Senate. We need a hearing in the House. I remember all of the hearings before. When there was a question about Hillary Clinton's emails, I want to run the tape on how many Republicans talked about the importance of accountability and getting to the bottom of this. Where are they right now? I'm ready for those hearings, and the FBI needs to step up.
This was a chat that was organized by Mike Waltz, the President's National Security Advisor, and he addressed this in an interview on Fox News. Here's what he said. "We made a mistake. We're moving forward." I noted that by and large, the response from the administration has been there wasn't classified information here. And as a result of that, the Atlantic released screenshots of a lot of these conversations. We learned that there was information about planes, timing of this attack. You talk about the need for hearings. Are you optimistic that that's going to happen and that you're going to get to the bottom of what was in fact discussed on that chat?
So I think this is a question fundamentally about where is power in this country. I get it. Elections, we pick a president picks a team, and that's where power resides in terms of the execution day-to-day of various policies. But ultimately, it's people across this country.
And that was U.S. Senator Elizabeth Warren speaking to Bloomberg's David Gura. Now, more news out of Washington. U.S. Democratic Senator Elizabeth Warren says President Trump could fire Fed Chair Jerome Powell as part of a purge that she thinks may disrupt U.S. markets. Warren had opposed Powell's reappointment during President Biden's term due to his support for reducing financial regulations. But she told us exclusively she stands behind the independence of the Fed and other government agencies.
He can just mow through the Consumer Financial Protection Bureau. It's a form of lawlessness, and all the power belongs to the king, that it suggests nobody is safe, not even the chairman of the Federal Reserve.
President Trump has reiterated his desire for the U.S. to annex Greenland as Vice President J.D. Vance heads to the island. Trump says Washington needs Greenland for international safety and security, and that it is essential for defensive and offensive postures. Vance's visit to Greenland, which was initially billed as a family outing, has been scaled down amid local backlash. And that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.